Okay, let's jump right in. We're doing a deep dive today into what we're calling the dual axis market.
Exactly, because as of, you know, mid-December 2025, you have two huge forces at play.
On one hand, you have the Federal Reserve and its quiet tinkering with new operational tools.
And on the other, you've got these massive headline-grabbing stories, especially in AI and crypto compliance. They're just colliding.
So our mission is to cut through that noise, define those two axes, and show you how they're driving everything from equities to crypto.
And we have to start with the main driver, the Fed's operational shift. The whole conversation has pivoted to the, let's call it the plumbing of this system.
Right, we're talking about reserve management purchases, RMP.
RMP. It's a new acronym for a lot of people, but it's key.
So what is the New York Fed desk actually doing, and why is this suddenly more important than, say, the Fed funds rate?
It's all about managing reserve scarcity. RMP is, well, it's a tool for the Fed to inject liquidity by buying short-term treasuries. They started on December 12th. And you shouldn't think of it like the old QE, the quantitative easing. It's more of a surgical supplement.
How surgical? What kind of numbers are we talking about?
About $40 billion in the first month.
40 billion. So that's not insignificant.
Not at all. It's the core variable right now for short-term liquidity. It sits alongside the ONRRP operations, which usually drain liquidity.
So you have one tool adding reserves and another draining them.
Precisely. And that interplay, that's the main story for short-end rates, for gold, for anything sensitive to the cost of money.
What does the broader macro picture look like then?
It's stable, but tense. The 10-year yield is around 4.18%.
And the 2-year?
About 3.53%. So that narrow spread tells you the market is still uncertain about the long term. Inflation is still a bit hot, but the labor market's holding up.
So the consensus is for gradual rate cuts, eventually. But the action is all in the RMP right now.
That's it. Stability now, uncertainty later.
Okay, that makes sense. So let's do a rapid scan of market sentiment, because the emotional temperature seems a little disconnected from the Fed's calm mechanics.
It is. It's a classic disconnect. You look at the VIX, the Institutional Fear Index, and it's floating between 15 and 16. Pretty low.
So the big players are calm, they trust the Fed's tools.
They do. But then you look at the other side of the spectrum.
Crypto.
Yeah, crypto. The Crypto Fear and Greed Index is way down at 29. That's deep in fear territory. It shows you the emotional fragility of that market.
I love that framing. Institutional stability versus retail fear. How does that play out in equities?
You're seeing a redistribution. Broad indices like VOO, which tracks the S&P 500, are holding up near their highs. The liquidity floor is there.
But the tech stocks, the QQQM.
That's where you feel the pinch. They're much more sensitive, much more volatile. That RMP money isn't flowing everywhere, it's being strategic.
Let's pivot to crypto then. What's the temperature there?
The theme is consolidation and leverage cleanup. Bitcoin's trading around 90K, but it's choppy.
Driven by what?
Almost entirely by leverage liquidations. A small price move wipes people out, causing a bigger move. That's why the fear index is so low.
And Ethereum?
ETH is around 3,100. There, the focus is more on what the large holders, the whales, are doing and the derivatives market. BNB is a bit different, holding a tight range around 894.
Okay, so that brings us perfectly to the second axis of the market, the differentiation. This is driven by sector news, not the Fed's balance sheet.
Exactly. This is where it gets really interesting. Two big news streams right now. First one is dominating the headlines, AI, and specifically NVDA.
Of course. What's the latest with them?
The stock's trading in a tight range, say 176 to 184. The volatility comes from reports that NVDA plans to ramp up production of its H200 chips.
And why is that?
To meet demand from the Chinese market.
Ah, so this isn't a supply chain story, this is geopolitical risk.
It is. Congress and regulators are paying very close attention. The concern is about the dual-use nature of these chips, their potential military applications.
So NVDA isn't just trading on earnings anymore, it's trading on the risk of, what, a congressional hearing?
Absolutely. It totally overshadows minor market moves.
Okay, what's the second news stream?
FinTech and crypto compliance. Less drama than chip wars, but it signals the maturation of digital assets.
Example.
Take Circle, CRCL. It's trading near 83 to 88. They just got a huge license in Abu Dhabi.
And why is that a big deal?
It's massive for their USDC internationalization. Getting that stamp of approval from a major financial hub opens up a huge region for them. It's a big regulatory win.
And Coinbase, I hear they're also expanding.
They are. Coin is around 267. The news is they're restarting user registration in India. And, crucially, they're planning a local fiat on-ramp by 2026.
India is a gigantic market.
Huge. So stocks like Coinbase, Circle, even Robinhood are benefiting from this validated expansion and compliance progress. Let them sort of decouple from the general tech volatility.
So let's put it all together. The Fed's quiet mechanics on one side and these loud, differentiating news stories on the other. What does this mean for you, the listener, trying to navigate all this?
The strategy has to acknowledge that dual axis structure. The Fed's RMP provides a liquidity floor, right? It prevents a systemic crash.
Okay.
But the industry and geopolitical news, that's what drives the big moves, the real differentiation between winners and losers.
So, in plain English, what's the approach? Do you chase the NVDA headlines or stick with the Fed's stability?
Patience and risk control. For broad exposure, I'd say use phased purchasing for indices like VOO and QQQM. Don't chase the highs, just scale in slowly while the market digests all this.
And what about the really speculative plays? The pre-stocks for companies like Anthropic or XAI, the HYPE token.
High risk warning there. I have to be very clear. These instruments carry extreme beta, contract, and liquidity risk.
Break that down. What does extreme risk mean?
It means the value is incredibly volatile, the contracts might be opaque, and most importantly, you might not be able to sell when you want to.
So, not for the faint of heart.
They are only suitable for extremely small positions. And you absolutely must verify contract addresses and custody arrangements before you even think about trading.
That's a critical point. The low VIX suggests calm, but that does not extend to the speculative fringe.
Not at all.
Okay, we've covered the policy, the sentiment, and the specific narrative drivers. A great deep dive.
And it does raise an important long-term question for you to think about. Given the Fed's active management of reserves through RMP, how will the broader money supply, the M2, which is currently around $22.3 trillion, how will that evolve?
And what would that mean for asset prices?
Exactly. What does it mean for the long-term price comparison between something like gold at $4,300 an ounce and Bitcoin? Right now, that ratio is about 20.97.
That ratio tells a story, something for you to mull over. We look forward to our next dive.